When a company does a normal investment into another company, meaning they have purchased debt and/or equity securities, but does not have significant influence over the company, we account for them based on management's intent. There are three categories that exist: held to maturity, trading, and available for sale. In this video, we will review the accounting for trading and available for sale classifications. Held to maturity means management plans to hold the debt security for its entire life. Trading securities are used for debt or equity securities that management holds in an active trading account for short-term changes in price. Available for sale are used for debt and/or equity securities that management does not plan on holding to maturity or is not in an active trading account for resale. They are held until such time management deems appropriate to sell. Let's look at the accounting for trading and available for sale securities. Parker Corporation trades equity securities for short-term gains and losses on changes in market price. Parker Corporation purchased 10,000 shares of Microsoft Corporation common shares on November 10, 2014 for $42 per share. On December 1st, Parker Corporation purchased 9,000 shares of Apple Incorporated common shares for $90 per share. On December 31st, Microsoft shares were trading at $40 per share, and Apple shares was trading at $94 per share. Complete the following. Record the journal entry for the acquisition of the shares of Microsoft and Apple. The first thing we must do is record the purchase of these securities. Now, at this point, the entry would be the same regardless of management's intent. We debit the asset and credit the payment method. So on November 10th, 2014, we would debit the investment in Microsoft shares for $420,000. And then that is 10,000 shares times the $42 per share. Then we would credit cash for the same amount. Then on December 1st, we would do the exact same entry for Apple shares. We would debit the investment in Apple shares account, and we would credit cash. This time it would be for $810,000. Presents 9,000 shares at $90 each. Now, the stock is sitting in the active trading account. These are only held for short-term change in price, so these stocks would be categorized as trading securities. Trading securities must be carried at fair value, so before we can produce year-end financial statements, we must mark the position to market price. To do this, we must first find if we have a gain or loss on the positions. Microsoft shares began at $42 per share, but now are trading for $40 per share. That is a decrease in value of $2 per share. If you take the 2 per share times the 10,000 shares, you find that we have lost $20,000 on the Microsoft shares. Apple shares began at $90 per share, but are now trading for $94 per share. This is an increase of $4 per share. So the 4 per share times the 9,000 shares gives us a total gain of $36,000. So in total, the portfolio has gained $16,000, the $36,000 gain less the $20,000 loss. We must record the adjusting entries on December 31st. This is increasing the total value of the stock, so we must increase the asset value. The original investment account should remain at historical cost. So to alter the balance sheet value of the assets, we will use a fair value adjustment account. Since the assets are going up, we would need to debit this account. Our offset should be some type of gain-loss account. We will call this unrealized holding gain-loss on the income statement. Any unrealized gain or loss on trading securities is reported in the actual net income on the income statement. If it isn't available for sale, it would appear in other comprehensive income. This is the only difference in the two classifications. Now, the next question states, what amount of revenue would Parker Corporation show on the income statement? What amount would Parker report its investment in the December 31st, 2014 balance sheet? The income statement would hold any recorded investment revenue as well as any unrealized holding gain or loss from trading securities. The positions would be carried on the balance. In this case, sorry, skipped a sentence. In this case, we would simply show the $16,000 holding gain on the income statement. The positions would be carried on the balance sheet at a total of $1,246,000. This is the original value of $420,000 added to the $810,000 plus the fair value adjustment of $16,000. Finally, on March 1st, 2015, Parker Corporation sold the Microsoft shares for $39 per share. On March 15th, Parker sold the Apple shares for $98 per share. Record any necessary entries for these two dates. When we sell the investment, we must remove the investment off the books and record any cash received. The difference then would be the realized gain or loss. So for Microsoft shares, we would debit cash for the sales price. 10,000 shares times $39 per share, which is $390,000. Since we paid $420,000, this results in a loss of $30,000. Then we must remove the original asset. To do that, we would credit the investment in Microsoft stock for $420,000. Now, on March 2015, we would debit cash for $882,000. The sales price times the 9,000 shares. This would create a gain of $72,000. Then we credit the investment for the original $810,000. Now, how would the entries appear if this were carried as an available for sale securities? Let's review the exact same problem, except instead of being held in a trading account, they are treated as available for sale. I will be honest, I can really skip to December 31st. Every entry would be the exact same. The only difference will be the December 31st adjusting entry. Instead of crediting the unrealized holding gain loss for the income statement, you would hit the unrealized holding gains losses for other comprehensive income. The only difference in trading and available for sale in accounting is where the unrealized holding gains or losses appear. For trading, they are part of net income. For available for sale, they are part of other comprehensive income. Now let's talk about where this information would appear on the income statement and the balance sheet. For available for sale on the income statement, we would actually show nothing in this case because we haven't sold the position. We're holding the position for sale. However, we would show as part of other comprehensive income. So if we were to look at other comprehensive income, let me fix my formatting here. For other comprehensive income, so in other words, part of the comprehensive income statement, we would actually show the $16,000 as part of other comprehensive income. Now on the balance sheet, we would still carry the assets at the $1,246,000, which again is the original price, the $420 plus the $810 plus the $16,000 increase in value. So that gives you the $1,246,000. That's what we would show on our balance sheet. And again, for March 1st, 2015, I'm going to cheat a little bit and just copy down. There is no difference in the selling of a trading versus available for sale from an accounting standpoint. So keep in mind, the only difference between trading securities and available for sale is at the adjusting for fair value. When you adjust for fair value, the unrealized holding gain, if it is a trading security, would go to the income statement, so you have to denote that that's an income statement account. If it is an available for sale, it would go to the OCI account. So it would still be unrealized holding gains or losses, but it would be for the OCI, the other comprehensive income statement. I hope this video has cleared up how to account for these items.